I'd like to share some changes we are making to help you determine if your borrowers are ready for a mortgage. We know that you have borrowers whose income may be based on hourly work, and it can sometimes be challenging to evaluate for income stability. To help you with this, we're providing you with more specific guidance in evaluating hourly income. We're updating our description of fluctuating hourly employment earnings so you can easily determine what we consider as fluctuating and non-fluctuating hourly income. We're also requiring at least a year of employment history if the borrower's income comes from fluctuating hourly employment earnings. For hourly earnings to be considered non-fluctuating, your borrower must have worked the same number of hours with the same employer for at least 6 months. Our requirements for calculating monthly qualifying income are the same across all fluctuating employment income types and will depend on whether the income is consistent or shows an increasing or decreasing trend. If the income between the previous years and the year-to-date changed by more than 10%, we want you to do additional analysis to check for stability of the income. If a student loan will be excluded from the DTI ratio calculation because of a student loan forgiveness, cancellation, discharge, or employment contingent repayment program, you must include evidence in the mortgage file that the borrower is eligible or approved for these programs. This documentation must come from the student loan program or the employer as applicable. You need to have a full picture of a borrower's ability to pay a mortgage. That is why we are explicitly stating that flood insurance premiums and special assessments must be included when you're calculating a borrower's monthly housing expense and debt payments against their income. However, if the remaining expenses for special assessments are payable in 10 months or less, you do not need to include this payment in your calculations. At Freddie Mac, we support responsible lending and want to help your borrowers become successful homeowners.